What's up everybody, this is Leaf with Adaptable Wealth, and in today's video we're going to investigate the effectiveness of residential real estate as a diversifier in a stock portfolio. First, the correlation of annual real estate returns to stock returns is very low. In fact, the highest historical correlation of a real estate market to the S&P 500 is Detroit with a 0.45 correlation coefficient, and even this is considered a fairly light correlation. But because the real estate market moves so much slower than the stock market, annual returns may not be the best time frame to view correlations. Because of this, I took a look at the correlations of the 5-year and 10-year rolling returns and found pretty much the same thing, but a bifurcation between markets started to appear. The correlation for most markets decreased and some even turned negative, while the likes of Atlanta, Cleveland, Denver, Detroit, Charlotte, and Dallas increased but was still fairly low over a 5-year period. However, they increased even further over a 10-year period to the point that those same markets seem to be quite highly correlated to the S&P 500. Two notes on these grids though. First, I tend to ignore the extremely high correlations for Dallas because of the lack of data for the Dallas HPI. Second, the correlations for some markets become quite high for the S&P 500 and Dow, but a lot of them are negatively correlated to the NASDAQ. Just something to keep in mind. All in all, this shows that there are sufficiently low correlations between most real estate markets and stocks that it satisfies the objective of low correlation. The next factor to consider when looking at diversification is the risk-return profile and whether your expected returns per unit of risk decrease when you add real estate to your portfolio. At the national level, it's apparent that real estate will improve the risk-return profile of your portfolio. The average return per unit of risk is higher than for stocks. Real estate has a lower percent of down years, a lower average decrease in down years, and dropped 12% less during the Great Financial Crisis than did stocks. Having said that, you'll also notice there again is a bifurcation between metro markets. You have the worst markets in terms of risk-reward, such as Las Vegas, Phoenix, Detroit, Tampa, and Miami, where their return per unit of price variability is lower than the S&P 500. And their peak to low drawdowns were significantly larger than stocks during the GFC. Then you have the middle of the pack such as Atlanta, Frisco, San Diego, Chicago, and Minneapolis, where their returns per unit of price variability and peak to low drawdown during the GFC is about the same as the S&P 500. And some have higher percent of down years, but most don't. Some have lower average returns during up years and lower average returns during down years. Lastly, we have the best performing markets in terms of the risk-return trade-off. Here you have some surprising results with Dallas and Cleveland, but the rest are the high-flying northwest markets of Denver, Portland, and Seattle. I'd be careful here though. All these figures include the bubbly run-up that we're currently in, and these metrics will change once the real estate market crashes at some point in the future. Remember, however, this only factors in price returns. It ignores cash flow, loan paydown, and depreciation benefits. Once you factor those in, the total return will be a few percentage points higher than what is shown in these grids. Because of this, I'd say that real estate satisfies the objective of not reducing the risk-return profile when added to a stock portfolio. The next question is, how does it hold up during corrections or bear markets? I went back and looked at the behavior of real estate on a national level during stock market corrections and full-on bear markets since 1890. I define a correction to be a drop in stocks of 10 to 20%, while I define a bear market to be a drop in stocks of 20% or more. As you can see in this chart, real estate holds up very well during both corrections and bear markets. During corrections, real estate increases 6% on average and has dropped an average of 6% only 25% of the time. In other words, when stocks drop 10 to 20%, real estate is up 75% of the time. During bear markets, real estate does tend to drop, but not nearly as much as stocks. On average, real estate falls a measly 2%, while stocks drop 30% on average. While there have been times where real estate rises during a stock bear market, most of the time real estate will fall as well. The good news is that when real estate does drop during stock bear markets, it drops an average of 11% versus a 30% fall in stock prices. The combination of low historical correlations with the fact that real estate tends to hold up pretty well during stock market corrections and bear markets leads to my conclusion that real estate indeed acts as a diversifier in a portfolio. Another fact that supports this conclusion is that out of 19 times that stocks dropped 10% or more, real estate never dropped more than stocks. There have been several instances of real estate dropping while stocks have increased. again pointing to the low and sometimes inverse correlation between stocks and bonds since 1890. And don't forget the risk-return tables we just covered. This chart looks at real estate on a national level, and I already demonstrated that there is a bifurcation between markets. During the GFC, Las Vegas, Phoenix, Tampa, and Miami dropped 61%, 54%, 45%, and 51% respectively, not the bastion of protection that this chart shows. The final consideration on the topic of diversification is, can you hold the asset outside of the traditional financial system? As censorship of opinions that differ from the official narrative increases and the state increasingly targets its own citizens, it is becoming more and more important that we hold assets that can't be traced back to us or are highly resistant to seizure. Unfortunately, real estate fails miserably in this area. Being such a large physical asset and having to tie the property back to yourself to establish ownership exposes you to the possibility that a claim or judgment by the state be levied on the property, and there would be very little that you would be able to do to keep them from taking the property for pretty much any reason they want. One possible way to avoid seizure is to hold it in a corporation or other legal entity. This is out of the scope of this video, but if you do hold physical real estate, I suggest you at least look into holding it in some entity separate from yourselves, just in case you become the target of the state or other individual in the future. For the same reasons, it's pretty much impossible to discreetly transfer real estate to your heirs in a way that they won't have to pay taxes on it. The fourth and final reason for investing in real estate is that it has intrinsic value. I'm talking about real intrinsic value, not what I consider to be the fake intrinsic value of precious metals, diamonds, watches, and jewelry. In my opinion, intrinsic value lies on a spectrum ranging from being able to help you survive, to doing work for you, producing a cash flow, all the way down to what I refer to as a fake intrinsic value of being an embodiment of work done or energy, which is pretty much everything. Real estate has several aspects of the true intrinsic value, with the most important being that it can help protect you from the environment around you to a large extent. The land can also be used to produce food. It also produces a cash flow and is an embodiment of work done in that it requires significant labor and materials to build a house. Because of these very valuable aspects of true intrinsic value, there will always be a demand for real estate. There aren't many assets out there that can guarantee a demand regardless of the scenario. Well, that wraps up this video, folks, but I have many more videos on residential real estate. If you've ever wondered about the effectiveness of residential real estate as an inflation hedge, check out my video up here. Or perhaps you're new to real estate and would like to learn about the 5 ways you can make money investing in properties. If that's the case, check out my video down here.